Hello, welcome to Real Estate Reveal, Season 1, Episode 2. My name is Thurston Gale. I'm from Baird & Warner.
My name's Erica Campana, and I'm with United Home Loans.
In Episode 1, we talked about the 9 steps that make up the sales and loan process. And today we're going to go over the pre-approval process. Erica, when someone comes in and the pre-approval process is beginning, how does it start? What are you looking for?
So I would pull their credit, and they would take their loan application.
When you talk about pulling credit, you're talking about the credit score.
Yes.
What's a good credit score? What's a medium credit score? What's a high credit score?
I've seen credit scores range from the low 500s to the high 800s, but I would say an average median score is 700.
What impacts a credit score? What makes it negative?
There could be a lot that could impact a score. Negatively would be late payments, not enough credit, going above the 30% utilization percentage.
Okay. So you're looking for credit scores. What paperwork do people need to have?
I would like to see a month's worth of pay stubs, 2 months worth of bank statements from wherever their down payment's coming from. If it's a 401k statement, I would need a quarterly statement, and then also a copy of their ID.
Okay. What's a hard pull? What's a soft pull?
Hard pull is a credit pull that I would do, being a mortgage broker. That impacts your score, but if you were doing a soft pull, that would be from your credit card company if you wanted to raise your credit limit.
Okay, and what's debt to income ratio?
That would be something the underwriters look at. It looks at your income versus what you're paying every month in debts.
Okay, so we've talked about hard pull, soft pull, debt to income ratio, credit scores, paperwork, and did we talk about the credit bureaus?
The 3 credit bureaus are Experian, TransUnion, and Equifax, and that's where we pull a tri-merge, and then we would take the middle of the 3 of those scores.
Okay, and you have the ability to go to any one of those credit bureaus and pull your own score, and it's highly recommended that you actually do that before you meet with your professional, which is either myself or Erica. I think that pretty much covers many of the stages leading up until the final step, which is where you would get your pre-approval letter. The pre-approval letter is something that your loan officer would give you, and it would state the upper limit of where they're going to fund your loan. The reason why that's important is, A, as an agent taking you out looking for houses, I need to know what the upper limit is that you can afford, or what you're going to be funded at. I need to know that if you're shopping, you've been approved for $500,000, we don't need to look at the $550,000 house. The other thing that happens is there are times when the listing agent will tell us that unless our client has been pre-approved, they don't want to give us access to the house. So those are the 2 reasons why you would want to be pre-approved before you go out. Can you think of anything else? Have I left anything out?
At the loan application appointment, we could also look at different payments you would be paying. We don't want you to be paying anything you're uncomfortable with. So even if you can get approved for a higher amount, we want to make sure that you're comfortable paying that amount.
Okay. Well, I think that's it for this episode. Until next time, thank you. Goodbye. If you have any comments, any recommendations, please send them to us. And until then, thank you.
Take care. Thank you.